Good day, and welcome back to the 50-Day Property Challenge brought to you by EDPF Property Academy and Private Property. Today is day 16, and once again, we've asked our challengers to go out and watch the videos we've created whilst searching for their first property in this challenge. Enjoy session 4 as we teach you all about area, property choice, and finance.
So the first thing about area is that you have to choose it carefully. Do not just go into an area and say, I'm going to invest here. When you invest in an area, you need to do proper research. You need to understand the area that you're going to go into. You need to understand the people in that area. You need to understand the type of demographics that are there. You need to understand the type of properties that are there. You need to understand what is surrounding the area, what is within the area. Physically, whether there is a retail shopping center, whether there are schools, whether there's a university. And these things will all determine what the strategy is that you can invest and use to invest in that particular area. So choose the area wisely. I typically, when I buy a new property, I will never buy a property that I have not physically been able to stand on, whether it be a property that's already been built or a vacant piece of land. I want to stand and physically feel the ground in order to get that understanding of the property, get the understanding of the area, walk around the area, talk to the people in the area, find out whether they like it there, find out what's there, what entertainment is around, etc., etc., so that I can get a feel for the type of investment strategy that I will use in that particular area. Normally, I would not want to stray too far away from where I physically am, either my office or my home. But based on the fact that I've been in the game for 20 years, we have now looked at investments all across South Africa. So, look at the area that's closest to you first, and then grow your portfolio outward. The reason why I say that is because if you live in an area or you work in an area, you generally know that area pretty well, and you'll know whether it's a good area to invest in or not. If you don't, do your research, understand the area, and let's talk about how you can do that research. So the first thing you do is to get to know all of the real estate agents that work in that area. Why? Because they know all the properties in that area. Real estate agents have investigated and done all the hard work for you already. They've already gone knocking on all the doors and saying, would you like to sell your property? They've walked through most of the houses in that area to see what those houses look like. And generally, a good estate agent will be able to tell you, when you tell them which street you want to buy in, they will tell you who the people are in that area, in that street, what types of houses are in that street, the sizes of the homes, how many bedrooms, how many bathrooms, etc., what the bonds are on those properties, etc. They can tell you almost everything you need to know about the area that they service because they specialize in that area. So it's very important to get to know the real estate agents for your research purposes. But more than that, also for opportunities. Estate agents can be your best friend or your worst enemy. On the one hand, if you treat them well, if you don't talk nonsense to them and just use them all the time for information, but you actually give them deals, either to buy or to sell, then they will be more willing and readily available to you and bring you good opportunities. More than that, what you need to do is to make sure that they understand the criteria of your investment strategy. And I'll tell you why. Because if you go to a real estate agent and you say to them, look, I want to buy in this property, I've got $1 million. They don't know what it is you're looking for. They will want to know exactly what type of property you want to buy. Whether it be a single residential home, where it's a family or an individual or whatever, how many bedrooms, how many bathrooms. If you want to do multi-let, you need to tell them that. so that they look out for properties that has more than one room, that can be shared by different people, where there's communal areas that can be shared by different people. If you want student accommodation, they will look for properties that are conducive for student accommodation. If you want to take a residential property and convert it to a commercial office block, then they will find you that. If you understand what your strategy is, you explain that to your real estate agent, they can become your best friend by then finding you those deals. They will find you anything that you want, as long as they understand what it is you want. You need to tell them how much money you have to spend, what that range is that you want to buy in from a cash perspective, how much cash you have, how much debt you have or you would like to have, what you qualify for from a bank, whether you have investors that will put money in. That will determine the time frame in terms of how long it will take you to raise the capital. You need to tell them all these things, because then they do not look for something where it's the person wants to sell quickly and you need the money tomorrow. If you explain to them that you're an investor, that you have X amount of cash, you have X amount of debt that the bank is willing to give you, but you've also got Y in terms of how much investors you have, then they'll know what amount of money you have to play with, how long it will take for the money to come through, and what they need to build in terms of the terms of the sale agreement or the offer to purchase, in terms of the funding of the deal. They will also know exactly what it is you're looking for from a structural perspective, from a physical perspective. Okay, so once you get to know the estate agents, they start bringing you deals. Don't just believe what they tell you, because in the beginning, they'll try and sell you anything. They're salespeople. Of course, they're going to try and sell you anything. And you'll find salespeople who can sell ice to Eskimos. So make sure that you do external research as well. How do you do that? You get to, like I said, go and talk to the people in the area, walk the streets. But you can also do research online. Now, there are many portals that you can use to do research online. Two such portals are Property24 and Private Property. And there are many other such many such other portals that you can use on the internet that you can research properties in any area. So you want to buy between 500 and 1.5 million, 500,000 to 1.5 million. You know that you want 3-bedroom home. You know that you want 2 bathrooms. You know that you want a big kitchen. You know that you want 5 parking bays, etc., etc. You then put in all those criteria and the area that you want to buy in, or areas that you want to buy in, and it spits out a bunch of properties that it's available for sale. Now, typically, when you look at these types of portals, they are generally portals where people are trying to sell at top dollar. Sellers always want more than what their property is worth. So you need to be good at negotiations if you want to buy one of these properties. Identify those properties where the seller is distressed or the property is distressed, and we'll talk about that when we talk about property. But make sure that you don't go and look for those properties that are being sold at top dollar. When you look at those properties, make sure that you can make your money up front by buying below market value. And this is where your negotiation skills come in. Okay, be very careful there, because these platforms will generally be platforms that will be overpricing for what you're looking for as an investor. These platforms are generally used for people who want to buy property, sell property, and those who want to buy property are looking for a place to live. So the property has more emotional value than investment value. However, what it does give you is an understanding of what you can sell the property for. So if you get the estate agents to bring you deals that are not on the market, you can then use these tools to see what you can sell the property for, and then compare and see what the margin is that you can make as an investor. Okay, the next types of portals that you can use, and we'll talk a little bit more about portals at a later stage, is things like TPN and Lightstone. With these portals, you can look at pricing, you can look at the properties that are available, the households, the demographics. You can look at what types of people are living there, what types of salaries they earn, what the age groups are, whether it's school-going children. So that obviously if it's school-going children, then you need to look at schools. If it's elderly people, then obviously that's things like old age homes and so on. That's what places like TPN and Lightstone will give you, is an understanding of those properties and what those properties look like in comparison to other properties in the area. You can look at rental incomes, you can look at selling prices, etc. And again, we'll talk a little bit more about that in the next session. Right, now let's talk about property. Which property are you going to buy? There's a saying in this industry that goes, find the worst house on the best street. That means that if there are 20 houses in the street and they all look good except for that one house in the corner over there or over here, you look at that property and you say, this property isn't in such a good state. However, if I do X, Y, and Z to it, spit and a polish, do some paint, lay some tiles, then I could get it to the same standard as these other houses and then possibly sell them for the price that these houses are going for. You can buy it cheap because it's in a distressed state, and you can sell them high after you fixed it up. Look for the worst property on the best street. Then look for distressed sellers, not buyers as I put there, distressed sellers. My humblest apologies for that. When you look for a distressed seller, you're looking for somebody who either owes the bank more than what they can repay, so their bond repayment they can't afford anymore, either because they've lost their job or maybe they are self-employed and they're just not able to cover the bond anymore. Maybe they were renting it out to somebody else and the rental income is just not covering the cost, and a whole host of other reasons why they could become distressed. Or they could be wanting to emigrate. And because they're emigrating, you are then looking at somebody who wants to sell quickly because they're wanting to move out of the country. And sometimes you may even pick those units up with the furniture because the people moving are not going to move with their furniture overseas. So the reason why you do this is because with a distressed property or a distressed seller, you could easily pick that unit up at below market value. Now, I'm not advocating that you try and rip people off here. What I am saying is that you could help people out of their situation where they are in a distressed state, they need to sell because they need to pay up their bond, or they need to sell because they are moving. You can help them out by buying their property from them at a reasonable price, but low enough that you can still make a margin. Do not try and rip people off because that is not the way people of integrity do business. When you go out there and you look for distressed sellers, you're looking for people that you could potentially help out of a bad situation, pay up their bond, give them some cash to get going in the next phase of their life, and then at the same time making a margin for yourself because you're an investor. You're doing this not just to help people out, you're doing it to make money. But don't make money the most important that you then screw people over. Okay, so if you found a distressed building, property, or you found a distressed seller, you can then make a margin between what you're buying for and what you're selling. You can do a bit of renovations on the property if it's necessary, and then put it back on the market in a flip deal to sell it. Alternatively, you hold it for the capital growth, and in the meantime, while you're holding it, you're renting it out at a reasonable rate in order to cover your cash flow and make sure that when you rent it out, you're making some positive cash flow. Okay, now you have looked at the area, the strategy, you've decided on your strategy. You have looked at the area in which you want to invest. You've decided on the area, and you found the perfect distressed property that you want to now renovate and sell, or renovate, hold, and rent out. The problem is you don't have any money. So the next step is, how do you finance your deal? The most obvious way is through a bond. When you buy a property, you go to the bank, you say, Mr. Banker, Mrs. Banker, Miss Banker, I would like to buy this property and I need R1 million. I have 10,000 Rand or 100,000 Rand deposit and I want to buy this property, so lend me 900,000 Rand. That's a straightforward bond. Sometimes the bank will give you as little as 20% in very extreme cases, but sometimes they'll even give you 110% because you're a first-time buyer, for example. What they normally do, why they want to give you 110%, is because normally first-time buyers cannot afford and don't know about the fact that they have to cover the costs, the legal costs, the transfer duty, etc. So they normally, on first-time buyers, will give you up to 110%. That 10% then covering all the costs. Sometimes, even if you're not a first-time buyer, the bank will give you 110% because you've built up a good reputation with the bank and your credit worthiness is in a very good state. In most cases, however, the bank will require at least a 10 to 30% deposit. You need to come up with that deposit. You need to come up with the legal costs, sometimes the transfer duty if it's over R1 million. Anything under R1 million, you do not have to pay transfer duty. However, you still have to pay the legal costs. And most times you don't have that. So that's then when other people come into play. If the bank won't give you a bond at all, you can then do something called bond surety. You can find somebody else who will stand surety for you so that you can then buy the property, and the bank will then sell or give you the bond, will give you the bond on the basis that somebody else is standing surety, and if anything goes wrong, they will want to claim the money from that person. If you have somebody like that in your life, great, fantastic for you. Then they can help you and stand surety for you in order for you to buy that property. The next thing is personal credit. So sometimes if you don't have the deposit or you don't have the money to pay the legal fees and the transfer duties, you can use a credit card or you can use a personal loan. And by using that, you can then pay your deposit and or your legal fees. I would only recommend this if the rental income is enough to cover the monthly repayment of both the bond, all your other costs like municipal costs, etc., repairs and maintenance and so on, and on top of that, the repayment on this personal loan or credit card. Or if you can repay that personal loan or credit card quickly enough that it doesn't affect your monthly cash flow. Because remember, whenever you invest, it's all about your net income and your net cash flow. All right. And we'll talk a little bit about the difference between net income and net cash flow in the next session. So when you do purchase a property and use personal credit, make sure that you're always going to be cash flow positive, or you can repay that debt quickly, because it could become quite expensive, because personal credit is normally a much higher interest rate than a bond would be. Sometimes people will take out 100% bond and then pay the legal fees up front using personal credit, and then pay that back quickly, and sometimes even build into the purchase price those costs, and then when the bond gets paid out, you can then pay back the personal credit that you've taken. Okay, so the next one that we want to talk about is equity gearing. Equity gearing is very interesting, and it can help you build your property portfolio much quicker than if you just buy each property individually without using the equity that you have in your property. What is equity in your property? Equity in your property is the difference between what the property is worth and what bond you have. So let's say you bought a property, it cost you 750,000 Rand. You've paid a deposit of say 250. Now your bond is 500,000 Rand. 2 or 3 years down the line, you've paid some of the capital, the bond is now 450. And your property has grown to R1 million. The value of your property has grown to R1 million. So now the difference between the value and the bond is 550,000, because remember you paid back about 50,000 of the capital. So now you're on 450,000 rand bond. So that 550,000 rand is what they call the equity in that asset. You can then gear that and go to the bank and say, I've got this 550,000 rand equity. I need a deposit on my next property. Can I lend 300,000 rand against this property? We then take that 300,000 rand, use it as a deposit on the next property, take out another bond on that property, and collectively you now have two properties that's worth, say, 2 million, but you've got debt of, on the one property, 750. Remember, you had 450, you borrowed 300, so that makes it 750. On the other one, you borrowed 700,000, and you put a 300,000 rand deposit in from the cash you got with the equity in this property, the equity gearing. But now you've got two properties worth 2 million, 1 million each, with debt of 1.45 million. So you now still have equity in that in those two properties of the 550, which is the difference between the debt you have of 1,450 and the assets you have of 2 million. So the equity you still have is still the same. And you can gear that again and again and again until you have gotten to a portfolio size that you are satisfied with and you've had enough and you don't want to grow it anymore. I would say that will never happen. Once you've got the taste for this, you probably will want to keep going. And you'll keep using the equity that you have in properties to gear in order to lend more money for the next property deal. Okay. The next one is asset finance. What is asset finance? It's similar to property gearing, except that now you're using other assets. So I could, for example, refinance my car. Let's say there's about 200,000 rands worth of value in my car. I go to the bank and I say I need 150,000 rand. Can you lend it to me against my car? I then take the 150,000, I put it down as a deposit on a property that's worth 1.5 million, and I take a bond then of 1.35 million. All right. So you use the asset that you have, in my case, the car. I lend money against that car. That's asset financing. I then take that 150,000 as a deposit on the next deal. All right. So that's asset financing. The next opportunity is partnerships. You can bring a whole lot of people together in different ways, whether it be a stokvel, whether it be a PTY limited company, or just a straightforward partnership that's governed by a legal contract, or you could do a co-op or many other different legal structures, trusts, and so on. But as a group of people, as a partnership, you come together, you invest collectively, either in cash or in sweat equity, in the effort that you've put in. And then collectively, you invest in property. That is a partnership opportunity. You can then bring the sweat equity, you bring the deal, you find the deals, you do all the work, you structure, and then bring the partners in with the cash, and then purchase property that way. The next one's an interesting one, seller finance. With seller finance, you can get the seller to actually finance the deal for you. So instead of going to the bank to lend money, you say to the seller, look, the bank won't lend me money, but I can afford to pay you monthly for 5 years. Now, normally a seller wouldn't want to stay, if they like this kind of deal, they wouldn't want to stay in for as long as a bank would for, say, 20 years. They may want to stay in for 3 or 5 years. So the best option here is to go into something like an installment sale agreement, where you're buying the property from the seller, and you commit to paying a fixed amount every month over a period of time. So they effectively becoming the bank, and they become the bond holder, so to speak, in order for you to purchase the property from the seller themselves. The next one is owner finance. Now, the difference between seller finance and owner finance, in my opinion, other people might differ with me. With seller finance, they are actually financing the deal, and they are your bond holder. They're lending you the money effectively. With that seller finance. With owner finance, what you do here is it's almost like a back-to-back deal, where the seller or the owner of the property comes in almost like a partner in the business, where they will put up their property. You then structure the deal, maybe do some renovations at your cost, and then you sell the property collectively to somebody else. So the owner is financing the deal by putting in their property. You are collectively with them, throwing in either with your sweat equity or your money in terms of renovations, and then you sell it to somebody at a higher market rate and you share the profit. So that's owner finance. The next one is venture capital. Now, generally venture capitalists, they also use other people's money. They sit with a big chunk of money and they invest in different ventures, different business opportunities. Normally, venture capitalists would not look at new stuff. That's for angel financiers, and we'll talk about that later. Venture capitalists like to do deals with people that they know, people that have a history, people that have experience, and they bring you deals that has a high return. So venture capitalists will put in other people's money, sometimes even their own, collectively putting into money into new business opportunities or growing business opportunities, mostly growing business opportunities. So if you have a history, you've got understanding and knowledge, experience, you then come to a venture capitalist and you say, I want to use your money in order to create more money in this venture that I have. And in this venture being property, using other people's money. All right. Then there's private finance, similar to venture capital, except that it's normally a little family practice where they have put in, the family has put in their own money, or they've taken money out of collective investments that they've had, and they're now busy investing directly as a family from their little family unit. So you then generally go to these types of investors and raise money through them in order to purchase property. Then angel investors. Angel investors are people generally who believe in you. I have a typical example, and I can tell you thousands of stories of things that we've done in the last 20 years. 4 years ago, I went to a friend who, in my experience, is an angel investor. And I said, I want to start this new thing called the Enterprise Development Property Fund. I started explaining a little bit about what it is we want to do with the academy and so on. And he stopped me immediately and he says, Nigel, you know what? I don't actually care what it is you're going to do. I believe in you. How much do you need? I'll invest. Now that's an angel investor, somebody that's like an angel from heaven that comes to you and wants to support you in whatever it is you want to do. Somebody who's willing to take high risk for high return. In the start of something new, something brand new, something that you want to start that typically, normally the banks, even venture capitalists will not invest in because it's brand new. That's an angel investor. All right. Then rent to buy. My friend Meyer de Waal has a thing called I Rent to Buy. And we use this, and we're actually going to use that same methodology in the Enterprise Development Property Fund in one of the next phases of the organization to set up our own rent to buy system, which Meyer is helping us with. Now, rent to buy is interesting in that you're actually renting a property to eventually buy it from the owner. Okay? Now, rent to buy companies, what they do is they will buy the property on your behalf because the bank won't fund you. You can't get a bond because you've got an ITC record, but you do have repayment ability and affordability. And the investment you're making is bringing in enough money in order to actually pay back the facility. So what they then do is they buy the property on your behalf. They effectively rent the property to you. You are obviously renting it to somebody else because it's an investment property. You're not living in it. That rental income that you receive, sometimes you have to put in a little bit of cash yourself, and then you pay back the rent to buy company on a monthly basis over a period of time. During this time, you are also now, and what we do, how we help you, is to put you onto Meyer's My Bond Fitness program. What we do there is we help you to clean your credit record so that you can become bond ready, hence the name My Bond Fitness. Once you are bond ready, you then take ownership of the property because you can now get a bond. And typically what happens in the beginning, the rent to buy company will purchase the property on your behalf, but there's an agreement that says they either will sell the property to you in, say, 2 years' time at that same price or at a bit of a margin, because obviously they want to make some profit as well. Then they will rent it to you for that, say, 2 years. You clean your record, and then by the time you are bond ready and you can then take out a bond, they will then sell the property to you based on the agreement you signed 2 years ago. That is rent to buy. Very, very interesting, fascinating way to finance property. The last one that I want to talk about today is rent to rent. Now, typically here, what people do is they rent from a landlord. And I spoke about this earlier on in lease options in the previous session. You will rent from somebody. That person is your landlord. You then rent that to somebody else, either on a fixed basis or on an Airbnb basis. Preferably Airbnb, because that's where you can make more money. But again, the higher the return, the higher the risk. Always remember that. The higher the return, the higher the risk. So the return is higher, but the risk is higher because if you don't find any tenants, you then have to pay the landlord regardless because you stood guarantee for that rental. Okay, there are many other ways that you can raise capital using other people's money. Sometimes you can use a combination of all of these or other methodologies that you can think of and other people can maybe teach you. The idea is, though, that at the end of the day, if you do not have money, do not stress, because you have all these ways to raise capital so that you can start and or grow your property portfolio.
Thank you for joining us again on this day 16 of our 50-day property challenge. Watch us again tomorrow as we continue this journey with Matt Al and Jared Ricketts.